Hello and welcome to the June 24th, 2022 edition of Watching the Tape. If you are a client of HFG Trust, then you know that we have a value bias in the management of your investment portfolios. Stocks can be categorized in many ways, by sector, by size, by geography, and of course, relative price. In the relative price category, you have value stocks and growth stocks. And I would imagine that most of you are quite familiar with these terms and know what they mean, but here is a quick overview nonetheless. Value stocks trade at low prices to their book values. In other words, low market caps relative to their tangible assets, whereas growth stocks trade at high prices relative to their book values. Now, the explanation for the difference in trading prices relative to tangible assets or book values, it really comes down to how quickly investors expect those companies to grow their tangible assets. If you are paying a high price today for a growth stock, it's because you expect that company to increase its book value in the near future and pretty rapidly in order to justify that high price that you're paying for the stock today. So let me share some examples of value companies and growth companies that I'm sure you're familiar with to kind of further illustrate the distinction between the two categories. First, value stocks. Berkshire Hathaway, Walmart, Johnson & Johnson, ExxonMobil, Procter & Gamble, just to give you a sense. Next, growth stocks. Apple, Amazon, Microsoft, Google, and Tesla. So what makes this an interesting topic this week? Well, the universe of growth stocks and the universe of value stocks are not static. There is migration to and from these categories. So when a company's stock skyrockets so high that it gets to a point where the price to book value is too high for the value index, then that stock moves out of the value index and into the growth index, and vice versa. And it's really the vice versa part that is grabbing some headlines this week. So one of the major index providers, Russell, is moving some of yesteryear's high-flying growth stocks into its value index because the stock prices on those companies have fallen so much recently. And I'm going to name some names here. Facebook, Netflix, PayPal. These three are now considered value companies according to Russell. Facebook stock has fallen 53% this year. PayPal stock has fallen 62% this year. And Netflix, that stock price has fallen 70% year to date. Like I mentioned at the beginning of this video, we have a value bias here at HFG Trust. And over the very long term, and I'm talking 90 plus years of data, value beats growth. And that certainly has not been the case in the last decade or so, but recently, at least in the year-to-date period through a couple days or through yesterday, value has dramatically outperformed growth. So let's look at some numbers here. The S&P 500 is down 20% year-to-date. Now let's look at the pieces. There's the value piece, which is down 12%, and there's the growth piece, which is down a whopping 28% year to date. That's it for this week. Thanks for watching.